Well, the stock market isn't the real economy. That's been a big lesson of the past 1.5 decades. So if the AI bubble really does explode on Wall Street, would it be a disaster for the main street? With chatter about an AI bubble reaching fever pitch in a week when several big firms have said that they're planning to raid the equity markets, it's worth asking what happens to the economy if the whole thing starts to unravel. Well, the obvious comparison is the dot-com bust. And it must surprise you that back then, US consumer spending barely suffered. That's unusual for a recession, which 2001 was. Maybe that's because the people who owned those stocks were wealthy enough not to slash spending when markets collapsed. Fed research suggests that, if anything, this relationship has got even weaker over the past 25 years. Today, the top 20% of US earners own 70% of the wealth, and they hold more of their assets in equities or mutual funds than real estate. The problem is that these wealthier Americans are the only ones expending right now. Well, the bottom 60% who spend the same dollar amount as the top 20% are struggling under the weight of tariffs and now pricier gasoline. If the rich rear back spending even a little bit, a key pillar of US growth falls away. Still, this is not 2008 for one very simple reason. Deep recessions usually follow a debt binge, and that's not obviously the case today, even if leveraged retail investors have probably helped fuel the stock market boom. Back then, households were able to keep spending by raiding home equity release schemes and auto loans, until it all ended in tears in 2007 when debt had reached 100% of GDP. That looks harder today. James Knightley, ING's chief international economist, points to rising delinquencies on car loans and credit cards, which suggests financial stress is already building where incomes are lower. Then there's investment. AI-related spending has become a huge part of the US growth story, and the circularity is attracting more attention. The same handful of firms raising money, buying chips, leasing compute, and booking revenues off one another. That may still not spell disaster. But the fact remains that if you strip out AI, the rest of US private non-residential investment has been falling year on year for 6 straight quarters. Tech might be the source of a stock market correction, but tighter financial conditions and lender caution would bite across the board, particularly with the Fed's hands somewhat tied by rising oil prices.